Hey traders, before you chase those pips, let's talk about something even more important than profit. Risk management. Whether you're a beginner or a seasoned trader, this video will give you the exact tools to protect your capital and stay in the game long term. Look, I get it, you see those YouTubers flashing their wins talking about Lambos and private jets, but what they don't show you is the meticulous risk management behind those wins. Because blowing up your account isn't exactly glamorous content, is it? Stick around because what you don't know can blow your account. You can have the best strategy in the world, the perfect indicators, the most sophisticated algorithms, but without risk management, you're just gambling. It's not about if you'll hit a losing streak, it's when. And when that happens, will you be prepared? Quick fact, over 80% of Forex traders lose money, not because they can't win trades, but because they can't manage risk. They go all in on a single trade, chase losses, and let emotions dictate their decisions. Think of risk management as your financial seatbelt. You might not need it every trade, but when a market crash hits, it could save your account. Let's get into the nitty-gritty. These aren't just some arbitrary rules. They're time-tested principles used by professional traders to protect their capital and stay profitable. We're going to cover the essentials, step by step, so you can implement them right away. We'll talk about how much of your account you should risk on a single trade, the importance of stop-loss orders, and how to make sure you're being compensated for the risk you're taking on. This is the golden rule of risk management. Think about it. If your account is $1,000, risking 2% means a max loss of $20 per trade. That's it. Sounds manageable, right? That's because it is. This approach keeps you in the game long enough to learn, to refine your strategy, and to ride out those inevitable losing streaks. Remember, consistency is key in Forex, and you can't be consistent if you're constantly blowing up your account. A stop-loss order is your automated bodyguard. It automatically exits your trade at a predetermined price, limiting your potential losses. No stop-loss equals unlimited risk, and in the volatile world of Forex, that's a recipe for disaster. Now don't just slap on a random stop-loss. Set it logically based on the chart structure, support and resistance levels, not on your emotions or how much you hope to win. This one is all about making sure your potential wins outweigh your potential losses. A 1-to-2 risk-reward ratio means that for every dollar you risk, you aim to make $2. So even if you only win 50% of your trades, you're still coming out ahead in the long run. Remember, trading isn't about being right all the time. It's about managing risk and maximizing your winning trades. I know it's tempting to be glued to the charts 24/7, but trust me, more trades don't equal more profits. In fact, it usually means more risk and more chances to make mistakes. Focus on quality over quantity. 1 or 2 well-researched, high-probability setups a day are all you need. Be patient, wait for the right opportunities, and don't force trades. Here's a harsh truth. Losses are part of the game. Every trader, even the most successful ones, experience losses. It's how you deal with them that separates the amateurs from the pros. Don't let a losing trade throw you off your game. Don't chase losses or revenge trade. That's a surefire way to drain your account. Instead, analyze your mistakes, learn from them, and move on to the next trade. Now that you know the rules, let's talk about some tools that can make your risk management even easier. These tools are like having a personal assistant for your trading, helping you calculate risk, track your progress, and stay disciplined. Remember, even the best traders rely on tools and technology to streamline their process and improve their performance. A position size calculator is your secret weapon for determining the perfect lot size for your trades, based on your account balance and your predetermined risk percentage. No more guessing, no more risking more than you can afford to lose. Just plug in your numbers, and the calculator will tell you exactly how much to trade. It's that simple. Don't just keep your risk management strategy in your head, write it down. Having a concrete plan makes you more disciplined and helps you stick to your rules, especially when emotions run high. Include your max risk per trade, your daily loss limit, and your weekly drawdown cap, and don't forget to track your trades with a journal. Regularly review your performance, identify what's working and what's not, and adjust your plan as needed. Risk management isn't sexy, but you know what is? Consistency, longevity, growth. That's what separates the traders who blow up their accounts from the ones who build long-term wealth. Drop a comment below if you use a strict risk rule, or if you've learned the hard way. Let's learn from each other. Don't forget to like, subscribe, and hit that bell for more Forex tips. Trade smart, not just hard. See you in the next one.